Okay. Hello everyone. So we're gonna talk about the functions of central bank. So what is central bank? So central bank is a public institution that manage a country's money and banking system. Main mission is to maintain economic stability by controlling and giving them money supply to regulate country currency and setting the interest rates. So what's the core function of central bank? Basically, that we have like monetary policy, banker, currency insurance, financial supervision, and lastly, government bankers. So example would be the Reserve Bank of India. So basically, their repo rate is about 5.5%. Knowing for a country they don't have a fixed exchange rate, they want to control the economy and capital, and they do this just to determine. They do this so it will be determined by their supply and demand, the economy, and they have a limited capital movement, but flexible as well, but also not absolute. Okay, of their independent monetary policy. Okay, slide 5. Okay, so the primary roles of central bank. So basically, they just have a monetary policy which carefully manage money supply and credit. Then we have like currency insurance by holding an inclusive right to print and distribute national currency. After that, we have payment system management, which helps to oversee the country's operating payment for infrastructure and they to ensure the transactions are safe and trusted. So about the tool monetary, what is the monetary tool? So one, we have the open market operation. So it involves buying and selling of government bonds to control money supply, acting the central bank's main dial for adjusting economic speed. Under this economic stimulus, increased lending and economic growth. The second tool will be the interest rate management. So what is it? Basically, it's a cost for banks to borrow money from central bank, serving as a benchmark for all other interest rates in the economy. Helps to stimulate growth and control inflation. And lastly, two will be the reserve requirement ratio. It's just a deposit that banks hold in reserve rather than lending out. While it's powerful, but it's less used frequent tool, and basically it's just based on the high low of the ratio, more of a lending ratio and economic growth ratio. So the Federal Reserve open market, okay, basically they involves of buying and selling government security to control money supply and maintain price stability while supporting maximum employment. So we have two types. One is repo. Repos means buying and injecting money, and then the other vice versa will be the reverse repo, which is selling and removing money from system, and this raise interest rate. It's decided by FOMC, which they have meetings 8 times annually. To next will be the fund rates, federal fund rates. It's basically a commercial banks borrow and lend their excess reserve to each other overnight. Let's say if a bank falls short during that period, it can borrow from someone and put with a surplus. While Fed does not set this rate, it influences through various monetary policy tools to keep the rate we need to reach. Okay, then we're gonna talk about the repos. So in short, basically it's just buying a security from another party. Okay, and then with an agreement to buy back at a slightly higher price. Next will be the reverse repo. So basically, when a party buys back a security with the agreement to sell it back later. So interest on reserve balance (IORB) as of based on their website, based on the stats. Based on their statement as of July 30th, 2025, it's currently at 4.4%. But this rate has been in effect since December 2024. Plus, this rate is important because it helps to set up floor for federal fund rates and manage the overall level of interest rates in the banking system. Okay, the reserve requirement currently is set 0. Since 2020, somehow it was during the pandemic. So means this allow bankers to have more freedom, make more business and so. So it also means that banks no longer require to hold a specific percentage of their deposit as reserve. So just a basic theory of the impossible Trinity hypothesis. So we have like the independent monetary policy, fixed exchange rate, and last lower bottom will be the free capital movement. So in about Singapore for this, basically is Singapore has free capital movement due to minimal restriction, independent monetary policy, and a managed flow rate, as Singapore does not have complete fixed exchange rate. Okay. For most recent policy decision. So the decision was recently made on July 14, 2025, announcing of its existing policy setting for the ban, indicating the following aspect unchanged. So the slope, basically the rate of the policy was kept at its current modest pace, reflecting a calibrated approach to current appreciation. Then after their width remain unchanged, providing a consistent range for currency fluctuation. And then after that, lastly will be their level at which the policy band is centered with and was also maintained, signaling stability in mass long-term current management. In conclusion, the effectiveness of monetary policy, while it's a crucial tool for economic management, is not a panacea. Okay, its effective is highly conditional on the current economic environment. Okay, the health of the financial system and the speed of it, which can influence behavior. For instance, monetary policy is very effective at curbing high inflation by raising interest rate and reducing money supply. However, stimulating during a reverse recession can be limited. Such scenarios, central bank might face liquidity trap where further interest rate cuts have little impact because banks are unwilling to lend or businesses, consumers are willing to borrow. Often necessity coordination with fiscal policy and the use of unconventional tools such as quantitative easing. Understanding the nuance of these tools, the federal fund rates, repos, reverse repo, and IORB is essential for comprehending how central banks navigate complex economic landscape and strive for stability and growth. That's it for me. This slide is just a reference.